Hey everyone, how are you? Welcome to this video. Thank you very much for being here. What we are going to be seeing today is a performance review on what we have been doing during the last 6 months and how our portfolio has been performing. And we will go through some numbers and valuation, and I will show you how I might check in the portfolio and how we might perform in the future. Sorry about the format, but I think it's the best way to compromise time, and maybe I post here these things somewhere. So what you can see is that we have been having a really good return. You can see over there that we have been achieving almost 19% this year as of July, and a bit better than the S&P 500. I think this has been thanks to the changes in the methodology, much more strength into the numbers, valuation metrics, KPIs, rule engine-based decision making, and how we are tracking against the S&P. You will see all of it in the video. Here, quick through our current portfolio, but I would prefer to just go directly into what are the biggest changes of this month. So in this one, and let me do some markups here. In this one, we can see that we have been doing some changes. These companies left the portfolio. Nike worries about the new CEO and the turnover, how we were going to be able to change all of that. Globant, not really looking into the numbers. I was not really convinced that they are going to be able to turn around, and I think there are much better opportunities there. That has been one of our biggest losers in the last time, and I believe sometimes that we get anchored to our ideas, so I prefer a change there. And Agaro, same things. I think there are better opportunities there more than checking for a change in the valuation, right? Those both also, we have still Teleperformance, so we are playing out a bit in that field. So Nemetschek, that was a software company from Germany that has been performing really well. I really know the company, but I think the valuations were getting crazy. So I prefer to rotate that money into something else. Nasdaq also really great return and recovery from the April bottom. That was more of a temporary play. And Ferrari, we had a really small position, and I think valuation is really high. So it's better to have the money somewhere else. Also, still in our portfolio, because still we believe in those, but we can see here that we have Netflix, right? Netflix has been a great play for us, 500% almost, and Elf Beauty, that we can see that it was a really big increase in really a low amount of time. And I prefer to rotate those into other companies like these ones. For example, we have been adding to AMD, because we believe it's going to have a great and brilliant future in chip making. Google, because of valuation. Adobe, because of valuation. And Teleperformance, because valuation is so low, right? And we believe all the worries about AI and about the transforming business is going to be paying out in the long term. Maybe we need to wait, but we really, and I really believe on that. Which companies have we added to our portfolio? Louis Vuitton, MC in Paris, right? Great luxury company that we believe is going to be growing a better multiples and expanding a bit the multiples from the recent falls. And we believe it's going to be a good play because of current valuation and recovery. Honest, a small company, we believe it has some growth profile, and valuation is currently for a small company really affordable. And of course, Ethereum, we will try to play here out a bit in this value asset for cryptocurrency, really only a 3% of the capital on the portfolio, but I think it's a good play now that we will see the end of the bull run. So why have we been doing these changes? Well, look, if we look at June, we can see that our valuation at that point was 26 when we look at a P versus 24 now, gaining 2 basis points. And then we have more safety. We move up 5% into safety. Net debt, we have reduced. We have almost no debt in the portfolio. Well, almost. We have no debt in the portfolio. Revenue growth increased a bit, I suppose, by the additions into AMD and some companies that we believe are going to have a stronger growth. P also increasing, right? and the growth expectation is still high. Even if we have done already an 18% this year, we're expecting to grow during the next 5 years at around a 20% per year if earnings and valuations tend to go in alignment with our thoughts. Is that we believe that we are going to target a 15%, so we are greatly above that, and that's great. So some points here to look at about the breakdown on our portfolio. Risk reduce a bit from 6 to 5. We have less assets, less company. That's perfect. That's what I want. That's the number I want to be in, around 20. More diversification is not really good diversification, and it could operate in a contrary way. Thank you to everyone. Our existing copiers are holding and adding. This was 158. We reduced the risk, now sitting in the biggest area of low risk and medium risk. That's because I wanted to protect a bit more the portfolio now that everything is up and valuations in the US are really high, right? We're still a lot in the US. I believe that there are really good things. Dollar is weak. We have also the bills that Trump has passed, much more flexibility. So I believe these companies are going to be doing great in the short term. In the future time, maybe we will be looking into moving some of that into other areas. Sector is still really leveraged in these areas. Probably we will need to have a look into how to diversify that. So if we have a look now into where our companies sit, you can see that I have put these 4 buckets that I think transmit really well our strategy. Well, our strategy, as you know, probably is we invest in great companies that compound, but we buy them at really good valuation, right? We have the area of growth where we have AMD as our biggest play, right, with a really big part of the portfolio. But we have some other good companies that are going to grow with the chip making, AI, and also some more like consumer ones. We have companies that are going to still grow, but that are really core compounders like NVIDIA and Google. And then if we look into core compounders that are going to be growing margins and growing over time more slowly, I believe Netflix is going to be there really soon. We have Microsoft, Equifax, Standard & Poor's, Intuit, Uber, and Booking. Uber having some doubts there with Google playing so well in the space of taxi, and Booking a bit high in the P. And then in value, we go into Adobe, Louis Vuitton, Teleperformance, PayPal, and then we have the other area that is satellite that we have here, Ethereum and ELF. So this is how we are seeing our 4 buckets. I have realized that sometimes I say more we than I, but let's keep going. So this is a way of just seeing the performance and the percentage allocation in the portfolio and the average PE that these companies have, but not as interesting. Let's go through. And then if we go into our portfolio analysis, we can see here that our portfolio, we always try to have at least a EPS growth by more than 10%. That's why this is in red, for example. There are really areas and companies that are going to grow a lot, like I believe that AMD is going to perform really well, Google, Amazon, or NVIDIA, ASML, right? We have companies that are really great position to have a really good earnings per share growth in the next years with a really big return on capital. That's what we like and what we are looking for. And of course, that gives us a percentage for an average return on capital of 21%. That's really good with an earning percent growth. So this is the average of the entire portfolio. And this means that we are invested in really high quality companies. Our debt is awesome also. Our companies do not have almost any debt, or they have cash, so that also protect us. So we could have a really high P ratio, but at the end we have companies that have a really great cash balance, have a lot of cash, they have really good return on capital, and have an earnings per share growth that is really good. Now, if we go into this slide, I love it because it has the glasses and the happy faces. So in this slide, what I like to see is that um, we see our companies and how they are positioned, right, with the safety. This is a really good slide that helps me to understand where those companies are and if I need to be rotating them into others, right? So really helpful in that area. For example, we can see that AMD is starting to be a bit closer to the overvaluation, right? In this area means overvaluation. This is the mid range, and this is undervaluation. We can see that Teleperformance is the lowest one, right? Google in the middle. So if they are in this area, we're basically happy. Why? We are happy because our companies, they still have a safety, they still have some room to grow, and we can still see them growing. But if they are starting to be in this area, right, this is why we have a bit less weight in these companies, is we are starting to be concerned because the valuations are starting to be really high for those companies. Like for example, Standard & Poor's, Intuit, Microsoft, Elf, all of these have done tremendously great for us, but they are starting to be expensive. Should we rotate that? We have already rotated Elf, and we have already rotated Netflix. That, as you can see, Netflix is really close to here, but then they release earnings and their forecast is even better. That's why it is not so high now. Then you can see here that Equifax and Booking, really small holdings, do not know if how they are going to perform with such high valuations. But anyways, they provide also a great diversification. And I think they are great companies that could grow really well during the next years. That's why we are in them. This one, and it helps us to make decisions in a monthly basis. And then if we look to our internal analysis, for example, Teleperformance is at a P ratio of 5%. So we believe that is going to do an incredible almost 50% per year during the next 3 years if the concerns release. AMD, it has grown a bit already, but we believe that we can achieve easily that 15%. So that 15% is what we are trying to achieve in a compound annual growth basis, right? More or less, but that's the average we are trying to get for our portfolio so we can balance a bit risk, but also profitability. Netflix, that's why we rotated. We are not expecting much on Netflix during the next years. That's why it sits here at a 7%, and that's why we have rotated it to companies that we believe that are going to have a better return, like AMD, Adobe, or for example, Google, that are all on the 20s or almost 30s, right? Then we have here Louis Vuitton. Also, we believe that is going to have a good return. And then we have here the ones that I was mentioning you that were a bit overvalued, right? We have here all this section that we are starting to think like, look, what do we do with these companies, right? Like we believe it's going to give us a 5% return in an annual basis. They are really good companies. They are compounders. Do we believe that is going to be a good idea to rotate them or not? And that's why we have our notes here. So the play right now is to wait a bit until the end of July or August, see where the market is going. I think that with all these laws, maybe tariffs going down, maybe interest rates going down, the new laws of cryptos, the bill that is going to pass through and is going to achieve greater returns in the next year, the dollar really weak, no one is able to buy a house, so everyone is putting money into the markets. I believe that is going to be well in the shorter term. That's why I'm waiting to see if these companies get really overvalued. And then as they get overvalued and they get to their maximum level of valuation, we start to rotate them to better plays, like, for example, Google, Adobe, Louis Vuitton, or other ones. These are my favorites to start to try to put a bit more weight on them. And just to finalize, this is one of my favorite ones, right? So we get data from WSG and Barron's and a few other places to be able to compare our portfolio to the S&P 500 or others. And I prepared this slide because I think it's going to be really useful. So as you can see here, we can see that our valuation right now, when in comparison with the market, you can see that we are at a PE of 24 while the market is almost at 27 in a forward basis. That gives us a margin of 12%. We have a safety margin from our valuation. So our valuation for our entire portfolio, right, the average is at 21% below at this point in time from its average, right? Because we have really great companies. But the S&P 500 is above 33%, so the margin of safety is really low if you invest in an index fund in the S&P 500, right? That's why stock picking maybe is going to be working better if you know where you are invested and you invest in companies really good that are at a low valuation, right? And you don't get into the FOMO. Net debt, we see that the S&P 500 and the comparables have a 2.4 debt ratio, right? And us 0%. So that means that we don't have any debt, or well, our companies have debt, but then the cash altogether it's a 0. So a really good number to come in here just at 0. That's really good. Revenue growth, what we can see is that we are 1.5 points above the comparable growth in a annual basis, right, in the earnings per share. I don't know why this is P, it should say EPS, right? We are at 8% above from the average of 8.8%. So our companies grow much faster, almost double. This is almost double, right? You can see that. And then our return on equity is also, this is an average between both. And then our is 21 and here is 15. This data could be up and down slightly. Maybe I didn't took the best data points from internet. This is from Wall Street Journal and Barron's and some data KPIs that I have. But anyways, it tells us a story that our portfolio is really strong when in comparison with the Standard & Poor's and the Nasdaq and the others, right? We are getting into a return plus 7% here. So our growth expectation is bigger, right? It's higher. And then a really fun one, I have this one here for you guys and for everyone, is I have here the valuation, and as you can see, where is the S&P 500? They moved from the minimum that is 15 to the maximum normally. That maximum normally is when you arrive at a bubble stage, a bit on the overvaluation side. And then we have here that our portfolio is in fact, and let me clean all of this. We see that our portfolio is in fact in the area that is from the middle point in the undervaluation area. And we are playing with a bit of a margin of safety from the middle point and from the margin of safety from the bubble point. These red parts are the bubble point for the S&P 500 and for our portfolios, right, on current valuation. But well, with this, hope you like it. Any questions, just let me know. If you want to copy, just think long term. Don't copy me for a few weeks or a few months and then leave. That is not going to be good for you or for your money, because you are not going to be able to participate in what we are building here, right? So I would recommend you to go into the long term with any of your investments, to look really well into what you are paying for the business or the investments that you are getting in. Look at valuation, look at earnings, look at those companies, how good they are, and try to do an assessment by yourself. And thank you very much for looking at this. I really appreciate your support and I really appreciate you being here. Thank you.